Hello and welcome to MasterChartsTrading.com market recap for the weekend on Friday, March 6, 2015. This week's recap will look at S&P 500, which on Friday printed a long red candlestick and broke a first support. The market reds also deteriorated somewhat, but is still bullish at the very least intermediate term and long term for sure. We'll also look at biotechs that are up over 40% from its October lows, but I think they might be ready for some sort of a rest. And another ETF, solar ETF, seems to have broken out and became long-term bullish, and we'll see if it becomes a new market leader. Bonds broke support with a gap down on Friday, and we closed our position on bonds. Gold and gold miners continued their downtrends, and oil may be ready to retest the January lows. The important disclaimer is all information on this video and on MasterChartsTrading.com is for educational and entertainment purposes only and shouldn't be construed as a recommendation to buy, sell, or sell short any of the said securities. Alright, so let's look at stocks. The S&P 500 large cap index candlestick chart. So I wanted to show some of the support and resistance lines. So first of all, after the October surge, the support held for 3 times, actually 4 times. You can say it 4 times as well if you count this support. So it held 4 times here and then finally bounced and it went higher. Now you can see that there was first support was broken on Friday. S&P 500 tested this support from mid-February on Wednesday and pulled back, but then on Friday it just sliced right through it and landed very close to the 50-day moving average. So and also on above average volume. So the selling was pretty significant. And right, so that's just the support and resistance lines. On the next chart, we will look at pure, signals that we get from our trading system. Now, this is a significantly different charts than what I used to show in the past, and I've been kind of playing around with these new charts, and I found them to be more profitable, even though they may give a little bit more whipsaws, false positives. But with my back testing, I did quite a bit of back testing, and it seems that these charts are actually more profitable, and even with the higher whipsaw rates. So this is a signal that happened on 17th of October, and then we took profits here and here. And then another buy signal happened on 18th of December. We took profits here and exit position right here. So there were actually quite a bit of there was 1, 2, 3 signals from here on, but it's possible to just get away with 1 signal because here the support held 3 times, as I showed on the previous chart. So with this charts, we can just enter right there on the 8th of January. We did enter the market, I believe, right here on the 3rd of February, and we took some profits along the way, I believe here and here on the February 24th and 25th, 26th. We also took some profits on this Friday because it's basically coming up on our target price. Now we haven't completely closed the position. I will close the position once this red line right there closes below this dotted green line. It's just the way I did backtesting. That's just one of the better timing opportunities to exit the trade with these charts. So at this point, I still have some of the position in the S&P 500 open, but Friday's action is not terribly encouraging. All right, let's look at market breadth for the S&P 500. So large cap index S&P 500. This is advanced decline line and advanced decline volume lines, and I don't see any divergence in it. Let me just turn this off. I don't see any divergence in the advanced decline line or advanced decline volume line, because you can see that the price made a higher high and the advanced decline lines made higher high. Same here and then here as well. So there is no divergence in the advanced decline line. In other words, the participation is broad in the stock market. Now, as far as intermediate term, the momentum breadth oscillators, they have definitely rolled over below their 10-day exponential moving average, and you can see, for example, what happened here. When they rolled over below their 10-day exponential moving average, we had a slight correction, a pretty significant correction. So I believe we're in the middle of that small correction, and it's possible that we will go all the way down to the 200-day moving average, especially if we close below the 50-day moving average. However, once again, the breadth momentum is still in a positive territory, so we could easily kind of do this number, just come right back up and see how we made a higher high. As far as the new highs, new lows indicator, we're still in a positive territory, but we're kind of slightly just around 2%, only 2%. So not something to be overly concerned, but something to kind of keep in mind. Okay, so I wanted to highlight a couple of sectors that I don't normally look at. So IBB biotech shares, and you probably have heard some news about the biotech that they were just on a tear. And in fact, from the October low until just the day before yesterday, this is about a 40% move. So it's a pretty significant move right there. And this indicator right there, SCTR, so this is called Stock Charts Technical Rank Indicator. You can see that in October, when the stock market kind of fell, and you can see here the IBB briefly touched the 200-day moving average, but let me show you on the previous chart, the S&P 500 in October actually closed below it, significantly below it, and spent some time below it. So as you can imagine, IBB in biotech is significantly stronger than the general market, and this was reflected in the stock charts technical rank. So when it popped, and on the next chart I'll show you the signal that we got as well, this was a very strong move, and whereas the S&P 500 kind of made a low and then high and kind of meandered here, this was just kind of like a straight move, and you can see that the SCTR kind of remained above 90 all this time. So on the next chart I'll show this. So right there on the 20th of October, this is a signal right there. And from there, this is about a, let me see, about a 40% move or so. Next chart, I'll show solar ETF. Now, solar is interesting. It was kind of in doldrums, and it was actually kind of bearish. So this red line is the 50-day exponential moving average, was below the 200-day exponential moving average. So that's one of the ways to determine if the security is in an uptrend or a downtrend. And since October, this security was in a downtrend. So it would make sense to short rallies at this point. But then here in February, it just broke out and just skyrocketed. to 45. So this was a significant move from 32 to 45. And also you can see that the stock chart technical rank went above 90. So now it became one of the market leaders as well. So it's definitely overdue for a pullback, and I believe it may have already started. So with this big red candlestick. So here you can see the Fibonacci retracements as well. So the first retracement may go to the $40 area, and then further down to 38, etc. Now, since this is a now became a bullish stock, because you can see the red 50-day exponential moving average crossed above the green 200-day moving average, it would make sense for me to buy the dips. So if the dip does occur, and I'm almost sure it will occur, then buying this dip would make sense to me. And on our public charts list, I will show I will put this similar chart where the trigger signal actually will be shown as well for 10 for solar ETF. All right, let's look at bonds. So TLT Barclay 220 plus year Treasury Bond Fund. So important thing is here on Friday, it just gapped below the support that it made on the mid-February, and just kind of gapped through it and continued down. Now this is a significant support break, and if you're a follower of a exponential moving average, as you can see here, that the 20-day exponential moving average went below the 50-day exponential moving average as well. Excuse me. Now, also the stock chart technical rank, see how bonds were really in the top, above 90 here, but now they kind of dropped below, and there's still bonds are clearly in an uptrend. The price is above 200-day moving average, 50-day moving average is above the 200-day moving average, but this is one of the more significant sell-offs in bonds that we've seen in quite some time. Okay, on the next chart, I have the same same thing, but with our signals in them, and you can see buy signal was on the 19th of September, way back here. Of I meant 2014, sorry, 2014 back here, and then here we had a buy signal as well on February 24th of this year, but as you can imagine, it didn't work out, and it collapsed below it. So support did not hold, and this signal clearly didn't work out. The previous signal worked out real well. Okay, let's move on to gold. Now, gold had just a horrendous week. The last week I thought that this support here held. There was quite a bit of hammer candlesticks and then a surge above, but it ran into resistance here in the $1,220 area, and then all last week it just kind of worked its way lower, and finally on Friday, around the jobs report, it just collapsed. So this was a really significant drop. The important thing is it broke this support. It landed in the support area here from beginning of the year, and clearly this is short-term oversold, so we may see like a rebound, and I think we have now resistance in this 1200 1190 area, so we're probably gonna get something like a rebound, and then more selling will occur. That's my best guess. I'm guessing we're going to move to new lows here. We will probably break this support at 1130. Okay, so GLD, now as far as the signals are concerned, on this chart, the short signal actually happened on January 27th. So, with GLD, it would have translated in about 9% gain if you're shorting here as well. Okay, let's move on to gold miners. Gold miners are like gold on steroids. So, when gold dropped like 3% or 2.5% on Friday, gold miners dropped 7.47%. So here, couple of things. It's a little bit busy chart, but okay. So the gold miners began its advance around November of last year and topped out in January. And so I put in Fibonacci retracements, and around 50% retracement is kind of like a normal retracement for the move, and that's where I kind of put the retracement. In fact, I thought here in mid-February, I thought the support actually held, because there was two somewhat bullish candlesticks right here, and then we rebounded, but clearly it didn't work out, and we had a bearish engulfing pattern, confirmed the next day, confirmed the next day, broke the support, and then collapsed. So gold miners are doing what gold is doing, and it's in a bear market. So this is a shorting opportunity. It was a shorting opportunity right here. As far as market breadth for gold miners, it's confirming this move lower, and even the bullish percent index for gold miners, same thing. It started to roll over even lower, because I thought it was going to hold in the 40 and possibly rebound, but it looks like it wants to go lower now. Same thing for gold miners, new highs, new lows indicator. You can see it went to the negative territory. And this selling on this Friday was done on very large volume. So this is certainly not a bullish sign for gold miners. It's definitely oversold. So once again, similar to what we have with gold, is we might see something like a rebound, and then most likely it will run into resistance around $20 area and then continue its downtrend. And finally, let's look at oil. So light crude oil, end of day price. So oil has been kind of in this range, consolidation range, and it's almost kind of like a bracket play. You can play it to the upside or you can play it to the downside. My money is on the downside, because this is a downtrend in security, and we have resistance here that we tested 3 times and failed each of those times. And then Friday we closed below the 50-day moving average, and we may be rolling over and going to retest the lows from January. So the next chart shows just a pure signal wise for USO, United States Oil Fund. It tracks oil pretty closely. I mean, it's not the best vehicle, but it's pretty good for trading. So similar thing, USO is on a downtrend, so it makes more sense to short the rallies. The short signal happened on February 10th. We were able to enter the market somewhere, I believe here. So we have an open position in SCO, inverse of oil, and I do believe it will retest the lows of January and possibly break them down. Okay, great. So just wanted to show you how to find us on the internet. So please go to MasterChartsTrading.com, MasterChartsTrading.com, and there we have our blog, and also our videos there as well that you're watching right now. They'll be posted in the video section. To follow along, you can go to our public charts page, and all of the charts that I mentioned here, or at least most of the charts, are there as well. Sign up for our mailing list. And also, if you have any Twitter, Facebook, YouTube, or StockTwits accounts, you can follow us there as well. All right. Thanks for watching and have another great trading week. Bye-bye.